In this recording, we will talk a little bit about interest rate and currency swaps and use a few examples to illustrate the concept. So let's start with the definition of a swap. A swap is essentially exchange of two streams of cash flows against each other. In an interest rate swap, we exchange a stream of floating cash flows indexed to a particular benchmark like LIBOR against a fixed stream of cash flows. In currency swaps, a stream of cash flows denominated in one particular currency exchanged against a stream of cash flows denominated in another currency. We can see or we can view currency swaps as a bundle of forward contracts because the amounts that are going to be exchanged going forward are fixed as of today. Therefore, we can see this as some series of forward contracts. In currency swaps, it is also possible to exchange a floating stream of cash flows in one currency against a fixed stream of cash flows in another currency. We call these type of cash swaps as cross-currency swaps. The utility of swaps are various. They facilitate cost-effective switching across interest rate and currency segments. What I mean by this is a floating rate borrower cost-effectively can restructure its borrowing interest rate structure into a fixed rate liability or fixed rate borrowing. Similarly, someone who borrowed in a particular currency can engage in a swap transaction and change the denomination of the interest rate and principal payment by using swaps. So swaps help a variety of players in the market to hedge their interest rate and currency exposures by facilitating these switches from one segment to another one. Swaps also play a role to eliminate the inefficiencies in fixed income and currency markets through arbitraging across the interest rate and currency segments. As markets, particularly fixed income and currency markets, became more efficient, this is less of an opportunity as compared to the early years of swaps or when the swaps were created or initially. The efficiency argument rests on the mispricing of credit risk and the resulting competitive advantage for the borrowers. What I mean by competitive advantage is that in a particular interest rate segment or currency segment, mispricing creates an opportunity for the players to borrow at a lower cost by taking advantage of those mispricings. For instance, a company may be perceived to be less risky in a floating rate interest segment as compared to a fixed interest rate segment. So this is a prime example of a mispricing across these two segments. Something similar might happen also in different currency segments. The same borrower might see a different credit spread in Japanese yen segment versus Euro segment or US dollar segment. As I mentioned, as fixed income and currency markets became increasingly efficient, these type of opportunities became less prevalent, but neither of these markets, despite their sheer size, are immune to mispricing. So that still happens, and swaps play a role in correcting these mispricings. A little bit about the volume of interest rate swaps. As you can see in here, interest rate swaps are significant in size. It reached to almost $700 trillion right around the global financial crisis. And then the volume dropped considerably to about $456 trillion in US dollar terms. So this is quite a significant volume. The measurement here is the notional principal, meaning that the underlying principle that is subject to a swap agreement is the basis of this measurement. So these are measuring the outstanding notionals in dollar terms. The currency swap market is much smaller as compared to interest rate swap market. The outstanding notional principal in this market is about $26 trillion. We might see a similar trend in here. The currency swap market has expanded considerably until 2009, 2010, and then there has been a trough since then. But it is still a sizable market. Let's explore the swaps through a few examples. We will start with a floating to fixed rate swap example. Here, a corporation, Microsoft, has borrowed about 100 million US dollars at a floating rate indexed to LIBOR at a cost of LIBOR plus 10 basis points, and would like to convert its floating rate liability into a fixed rate liability. Essentially wants to convert this floating rate note or floating rate borrowing or bond into a fixed rate borrowing or fixed rate bond. It is possible to do this by retiring the floating rate loan and then reborrowing in the market at a fixed interest rate. But obviously there are substantial costs involved in closing and reinitiating new loans. Swaps in these circumstances create a very cost-effective switch from one type of borrowing into another one. In this case, Microsoft can change the structure of its loan from a floating to fixed rate by engaging a swap with a swap dealer. Swap dealers are financial institutions that facilitate these type of transactions. So they make the market. They are prepared to pay a floating rate and receive a fixed interest rate, or they are prepared to receive floating rate and pay a fixed interest rate in exchange for that. So they can make market in both ways, whether a player wants to convert a floating rate borrowing into fixed rate by receiving floating interest payment and making a fixed interest payment, or a player who wants to convert its fixed rate borrowing into a floating rate by receiving a fixed payment versus paying a floating interest. So swap dealers can take both positions. They make the markets in both directions. So depending on the needs of the players in the market, they facilitate the transaction. So in this particular example, the Microsoft wants to switch from floating to fixed payment. Therefore, it is going to receive a floating payment from the swap dealer in exchange for a fixed payment that it is going to make to the swap dealer. So Microsoft's original loan involves or requires an interest payment, semi-annual interest payment of LIBOR plus 10 basis points. And in this deal, is going to receive the LIBOR payment semi-annually from the swap dealer and offset its payment that it is going to make to the lender. And this will leave the Microsoft with only the markup in this case, which is 10 basis points. In exchange, it is going to make a fixed interest payment of 5.0.5% to the swap dealer, again, on a semi-annual basis. So if you look at the net cost that this deal is going to bring to Microsoft, that will be the 5.05%, 5.015% interest that it is going to pay to the swap dealer, plus the 10 basis point markup, which effectively is going to bring its cost to 5.115%. So if you look at the what Microsoft is going to pay and what Microsoft is going to receive, we can determine that its fixed interest cost is going to 5.115%, because Microsoft is going to make LIBOR plus 10 basis point payment to the original lender, but it is going to receive a LIBOR payment from the swap dealer, which is going to offset this LIBOR payment, and will leave a markup of 10 basis point here alone. And on top of it, Microsoft is going to pay this fixed payment, which is 5.015%. And combining this 10 basis point markup plus 5.015% fixed interest payment, its effective cost is going to be 5.115% fixed throughout the swap deal. So by using this structure, Microsoft effectively converts its floating rate loan into a fixed rate loan on an annual interest of 5.115%, but the payments are made on a semi-annual basis. So if we graphically represent the deal, as you see in here, Microsoft makes a fixed payment of 5.015%, receives LIBOR, turns around and pays its original lender, which is LIBOR plus 10 basis points. So there is a 10 basis point net payment that Microsoft incurs in here, and 5.05% fixed payment that Microsoft incurred again. Combined cost is 5.115% for Microsoft. Obviously, all of these payments are based on 100 million US dollar notional. So that is the basis of the swap. And in swap statistics, that notional amount is used to account for the size of the market. So, for instance, this deal is going to be recorded as a $100 million swap deal in the market. If you look at the swap cash flows involved in this case, Microsoft is going to receive a stream of floating payments. Microsoft is also will make a stream of floating payments. There will be some offset in here, and also Microsoft will make a fixed stream of payments in here. The difference between the floating payments plus the payment that Microsoft makes to the swap dealer in fixed terms makes up the net cost of the Microsoft, which in this case, every 6 months will be $2,557,500. Just a quick note in here about the floating rate payments. The payment that is due on September 5th, 2014 is determined on March 5th, 2014, 6 months prior to the actual payment. This date is referred to as the interest reset date. So the next interest payment is always determined 6 months prior. In this case, for instance, LIBOR was 4.20%, and that is the basis of the interest payment that is going to be subject in the next interest payment period. Similarly, the floating payment that Microsoft is going to make on its original loan is also determined 6 months prior at the same date. And as a result, the LIBOR payments are going to wash in here. For instance, the next payment that is going to be made on March 15th is determined in September, which is 4.8%. And the actual payments are going to be on March 15th. So these are what we call the interest reset dates, which determine what the next floating interest rate or next floating interest payment is going to be. So if you do the math in here, the net cost for Microsoft in these 6 periods that we summarized in here are going to be $2,557,500 each, so essentially a fixed payment. The tenor of the swap agreement will depend on the original loan tenor. So it is going to be depending on what is the actual loan tenor. I just use these for illustration purposes, not necessarily cover the entire loan period. So let's go to the a floating to fixed rate swap arrangement. Let's assume that on the other side of the deal, there is a company like Intel that swaps its fixed rate loan into a floating rate loan. So the same swap dealer this time engages in a corporate entity. But the deal is almost just the opposite of what we discussed in the Microsoft case. In this case, the swap dealer is going to make a fixed payment to Intel and accept a floating payment from Intel. So Intel originally has a loan that is about 100 million. The loan is at a fixed rate of 5.2%, but Intel is interested in converting this into a floating rate loan. The motivations for this might vary. It might be related to an anticipated interest rate decline, or simply Intel's cash flows might be more aligned with a floating payment. As a result, they might want to engage in this deal. So motivations might vary, but regardless of motivation here, the intention is to convert this fixed rate loan into a floating rate loan. So the Intel in this case is going to engage in a swap deal with a swap dealer. It will pay LIBOR interest and receive a 4.985% interest from the swap dealer. Swap markets work always with these principles, that is, a floating rate is exchanged against a fixed rate. So always the floating rate is the LIBOR, and a fixed rate is determined in exchange for LIBOR. In this particular case, the interest rate, fixed rate that the swap dealer is going to pay to Intel is 4.985%. So if you look at the deal cash flows, the Intel is going to pay a 5.2% to its lender. This has nothing to do with the swap. So this is related to the original loan that the Intel has on its books. The swap involves a receipt of 4.985% fixed rate on 100 million notional, and a payment of LIBOR interest on, again, 100 million notional that is made to the dealer. In the swap, Intel receives 4.985% fixed interest, but pays LIBOR in exchange. If we net out all these payments, there's a fixed payment of 5.2% out to the original lender. A 4.985% comes from the swap dealer, and a LIBOR payment that goes to LIBOR, the swap dealer. And the net cost is the difference here, which is Intel is paying. On top of LIBOR, that means that the effective cost for Intel is going to be LIBOR plus 21.5 basis points. So by using this structure, Intel effectively transforms its fixed rate liability, which was at 5.2%, into a floating rate liability that is indexed to LIBOR plus a markup, which is about 21.5%. Or 21.5%, 21.5 basis points. Graphical representation will suggest that Intel is going to make the LIBOR payment, receive the fix in exchange, and then will service its loan and pay 5.2%. All of these are stated in annualized terms, but these transactions will take place on a semi-annual basis. And the annual cost or annualized cost for Intel is going to be LIBOR plus 21.5 basis points. So if you look at the cash flows, every 6 months, Intel will end up by paying these floating payments going forward. Of course, when this deal was initiated, or when the deal is initiated, we only know the next payment. In this case, assuming that we know what the LIBOR rate is on the date of the deal, we would know this cash flow. But all of the other cash flows on the floating side is going to be determined by the LIBOR rates that would transpire on these reset dates. So from the Intel's perspective, these costs are not known yet, can be maybe forecasted, but only Intel at the time of the deal will know this side of the deal. But all of the fixed payments are already known. So Intel knows that there is going to be a markup that is going to incur to Intel on top of the whatever transpires as LIBOR interest rate. So this is just a hypothetical case, knowing that we know what the future LIBOR interest rates are. Having said that, it is possible just to hedge these by getting into forward interest contracts. So it is possible just to convert them into some type of certainty. If you look at the dealer's perspective, dealer, as you can see in here, will receive LIBOR and pay LIBOR. So these are washes. They will wash each other. And it will receive 5.015% from Microsoft and pass 4.985% to Intel. It will retain 30 basis points out of the deal, and it will leave the deal with a 15 million profit per period, per 6-month period that it facilitates these payments. So dealer also makes its money from whatever it retains in these payments. So this was an example of fixed to floating interest rate swap. In this example, we're going to look at a fixed-to-fixed currency swap. So we're going to look at the cost of borrowing in British pound and US dollar segments. We will assume that the spot rate is 1.4995 and 1.5 at the time of this deal. There are two companies, A and B. The company B can borrow 5-year fixed rate pound at 12%, as this table shows. But the company is interested in borrowing US dollars. So if it did so directly, its US dollar borrowing cost would be 10%. The company A, on the other hand, is interested in borrowing pounds, but if it did it directly, it would cost about, or it will be able to borrow about 11.60% interest rate. Its dollar cost of borrowing is about 8%, as you can see in here. So if you look at the differentials in here, obviously US dollar cost of borrowing is lower as compared to British pound cost of borrowing. This could be simply a reflection of expected inflation in US and UK. But interestingly, when we look at the credit spread between these two companies, we see different pictures in here. First of all, it is clear that company A is a more credible company as compared to company B. So they can borrow in the US dollar segment at 8%, which is about 2% lower than what company B can do. And in the pound segment, they can borrow at 11.60% versus company B's cost of borrowing of 12%. The interesting thing here is that the credit risk differential in the US dollar segment is much larger as compared to the British pound segment. So this suggests that there is some mispricing in the market. Either there is mispricing in the dollar segment or the British pound segment. It is possible that in the dollar segment, company A's risk is underestimated, or in the British pound segment, its credit risk is overestimated. So this might happen because of informational asymmetries or other institutional reasons, but obviously there is some mispricing in here. As we mentioned in here, in dollar segment, there's 200 basis point credit risk differential. In the pound segment, that is only 40 basis points. This is definitely pointing to a mispricing in these different segments. So the question is what these companies can do. These companies indeed can take advantage of these mispricings. Although the company A is eventually interested in borrowing pound, it could indeed go to the market segment where it has a comparative advantage, meaning that it can actually borrow dollars far cheaper than the company B can, and then letting company B to go into its British pound segment where it also has a comparative advantage, although it is absolutely in a disadvantage in borrowing pounds because of its credit risk. But if you look at the relative cost, it is much more favorable as compared to US dollar segment. So in this case, company B is seen as only 40 basis points more risky than company A. So we could consider the pound segment as company B's comparative advantage and the US dollar segment as company A's comparative advantage, where its advantage is much significant. In this case, the company B's disadvantage is relatively low. So letting company A borrow in US dollars and company B to borrow in pounds and swapping the payments, we could potentially reduce each of those companies' cost of borrowing as compared to directly borrowing in pound or directly borrowing in US dollar terms. So let's see how this works. Um, so we could potentially reduce their cost and achieve better cost structures than we could by directly borrowing these segments. So if these companies ignore this information and went into the market and ignored their competitive advantages, they would incur higher costs borrowing in pounds or in US dollars. So in this case, a swap dealer can facilitate the deal. Let's say a swap dealer becomes aware of the situation and comes with a proposal and says, okay, I can pay you if you borrowed US dollars, I could pay you 8% on a principal of 15 million US dollars in exchange for a British pound 11% on a principal of 10 million British pounds. So essentially, at the spot market, the 15 million US dollar is equal to 10 million US dollar at the given prevailing spot rates. So as a result of that, the swap dealer says, I'll pay you 1.2 million US dollars, which is 8% on 15 million principal. And in exchange, we'll accept 1,100,000 pounds on a principal of 10 million in the deal. And the dealer offers a similar exchange to the company B, and it offers the company B a 12% on principal of 10 million pounds, meaning 1.2 million interest payment on 10 million principal, in exchange for a 9.4% on the 50 million US dollar principal. So the company B will pay 9.4% interest on 15 million US dollar principal. So the deal is that the payment that the company B is going to receive from the swap dealer is 1.2 million British pounds, which is essentially is going to cover its pound borrowing cost, and the company will pay 9.4 million to the swap dealer over a 5-year period, and will incur essentially a 9.4% cost in the deal. So as a result of this, the company A can go and borrow $15 million at 8% annual interest. Company B will borrow 10 million pounds at a 12% interest. But company A will get into the swap deal where the swap dealer will receive 11% on 10 million principal from the company A, but in exchange is going to pay 8% interest on 15 million principal to the company. So company A actually can cover its $15 million loan, or 8% interest on this $50 million loan from the payments that it receives from the swap dealer, and incurs a net cost of 11% on the pound. So if you watch the payments in the deal, the company A will actually borrow 15 million US dollars, and in exchange, we'll make 8% interest payments plus the principal in year 5. So these are the stream of cash flow that is associated with the original loan that the company A is going to initiate with $50 million principal. In the swap deal, the company is going to receive 10 million US dollar from the swap dealer in exchange for a 15 million payment. and periodically will make $1.1 million, 1 million pound payments throughout the swap deal, and eventually will also pay back the swap principal of 10 million. In the swap deal, it is going to, the company will make a 15 million payment to the swap dealer, and in exchange is going to receive 1.2 million, and finally the principal of 15 million on the in the fifth year. So all of these payments that the company is going to make to the original lender, and the payments that are that is going to receive in dollar terms from the swap dealer are going to offset each other. As you can see, all of the dollar payments are offset. So what is left in net terms is these British pound payments. So the company effectively received 10 million British pound, made 11% interest payment throughout the loan period, and eventually pays the principal back. So that means that the company's cost of borrowing of British pound is 11%. This is obviously 60 basis points lower than the cost that the company would incur if it borrowed directly in the British pound fixed interest rate segment. So if we look at the company B's cash flows, the company B, like the company, will go and borrow in the British pound segment 10 million British pounds, will receive 10 million British pounds. And the loan is on with 12% interest, and will make periodically 12% interest on that 10 million principal. Eventually, you'll also have to pay the principal back. So these are the cash flows associated with the company B's original loan. In the swap deal, the cash flows that the company is going to engagement with the swap dealer is to make a 10 million British pound payment. So the principal that is collected from the original loan is going to pay that to the dealer, and dealer is going to pay the company B 1.2 million British pounds periodically, principal plus the principal of 10 million at the end of the 10 years. So all of these cash flows are going to be offset in British pounds for company B. In the swap deal also, the company B is going to initially receive a 15 million payment in exchange for this 10 million payment that the company B is going to make to the swap dealer. So we'll receive a $15 million payment. And on the 15 million US dollar, we'll pay 9.4% interest periodically, plus the 15 million principal at the end of the maturity. So if you look at the dollar cash flows of the company, is essentially 15 million received and then paid out throughout the life of the loan. And this amounts to 9.4% effective annual cost for company B, which is about 60 basis points lower than the direct cost of borrowing at 10%. So as a result of this deal, both parties were able to effectively reduce their cost of borrowing. In this case, it seems to be that 60 basis points on both ends. It doesn't have to be that way, but the way the interest rates are structured, it turned out to be the situation. So both parties equally benefited from this deal. And the dealer itself retained some of the payments. As you can see in here, for the US dollar, it received 15 million from the company A, but paid out that 15 million to company B. It received $1,410,000 payment from company A. so it received $1,410,000 payment from company B, 9.4% interest on 15 million, and then turned around and made a $1.2 million payment to the company B, which is 8% interest on 15 million. So in the deal in the US dollar segment, the company had a net, the swap dealer had a net of 210,000 US dollars as a result of its payments and receipts from both parties. In the British pound segment, it receives the 10 million payment from company B, but pays out 10 million to company A, 10 million pounds to company A. The interest rate that it receives from company B is, I'm sorry, from the company A is 1.1 million pounds, but it makes a 1.2 million payment to the company B. So here there is $100,000 deficit periodically. This may be a typo in here. These should be 100,000 pounds. So there is actually a $100,000 deficit, but a $210,000, 100,000 pound deficit and $210,000 surplus in the deal. So at the prevailing spot rates, 210,000 US dollar is larger than 100,000 pounds, but the swap dealer here is taking currency risk, because if the pound were appreciating going forward, this markup could get smaller and smaller, or maybe even at some point 100,000 pound might exceed the US dollar 210,000 if it appreciates beyond 2.1. But that's an unlikely situation. In this case, most likely the swap dealer will close the deal with a profit, but obviously it is taking the currency risk in the deal. So this demonstrates a fixed to fix currency swap by using two different currency segments. So wanted to summarize that at the end of the deal, swap dealers most likely close the deal with some profit, but as we showed in here, its US dollar net receipts is most likely higher than its British pound net payments. So as long as its dollar net receipts exceeds its pound net payments, the swap dealer is going to close a deal with some profit. Swap dealer is also probably in a good position to hedge this risk if it desires to do so. So by assuming the currency risk, probably made this deal easier, and as a result, both parties were able to reduce their costs significantly, 60 basis points in each case, which is a substantial benefit. This doesn't, again, have to be the case. This deal could be structured in such a way that the swap dealer could minimize its currency exposure by clipping some of the benefits of one of the parties. in the deal. But of course, under those circumstances, in a highly competitive market, it will be risky because possible that these players can go into another swap dealer and engage in a similar deal with somebody else. In competitive markets, sometimes swap dealers will have to take this type of risks. So in this chart, we summarize the deal with all aspects. Here we have the original exchangeable principles because of the spot rate of 1.5 US dollar per pound, 10 million and US dollar 15 million are the notional principles underlying the swap deal. Company A borrows at an 8% rate, $50 million, and then engages in a swap deal with a swap bank with the agreement that it is going to receive 8% on US dollars, which is going to use to service its debt. And also it agrees to deliver $15 million that it procures from this borrowing to the swap dealer in exchange for 10 million payment that it is going to receive from the swap bank or swap dealer. And on that 10 million pound, it is going to make 11% payment to the swap dealer. Company B that borrows at 12% at 10 million pounds at 12%, takes the principal, passes to the swap bank and receives 15 million in exchange. So swap bank practically receives the 15 million from company A and passes to the company B, and similarly receives 10 million pounds from company B and passes that on to company A. So principals are exchanged through the swap dealer, and company B agrees to receive 12% on its pound borrowing or in the deal that is going to help to cover its entire pound borrowing. So we'll receive 12% payment on 10 million pounds and will pay interest for its original loan. And in exchange, it makes 9.4% payment on $15 million principal. In the deal, as you see in here, swap bank retains a 1.4% on $15 million principal, but it incurs a 1% loss on 10 million pound principal. So that amounts to 100,000 pounds, and this 1.4% of 15 million amounts to 210,000 US dollars. So as we described, as long as $210,000 is larger than dollar value of 100,000 pounds, this swap dealer is going to close the deal with a profit.